welcome to this quick podcast. I'm going to be looking specifically at bank statements in it and why bank statements and debit and credit entries are the opposite way around to in a business's bank account. Okay, here we've got an example of a bank statement, and we can see that this bank statement is from any bank, which is a made-up bank, and it's PR Patterson's account. That's the name of the business. I've adapted things slightly. We're going to imagine that PR Patterson's a pet shop. It's got his account number and something called a sort code, which you don't need to worry too much about. Okay, it's got a debit column and a credit column, and then over on the right hand side here, it's got what we call a balance column. And a lot of bank statements, these will have either CR or DR written next to them, depending whether it's an overdraft or PR Patterson actually has some money in the bank, and therefore from the bank's point of view that they owe the money to PR Patterson. And in this case, just because I've looked through it, I know that this would be a credit balance from the bank's point of view, i.e. Patterson has some money in the bank. Now thinking about Patterson's bank account in his own set of accounts, so the T account called Bank for Patterson, that would actually be a debit entry, because from Patterson's point of view, he's got an asset of being owed some money. From the bank's point of view, somebody called Patterson has given them £35, and this money is therefore owed to Patterson, so it's a liability for the bank. Most of these are payments going out of the bank, payments made by PR Patterson. So in this case, it's going to be a check, because this is an attempt at a check number by the person who's done this. And Patterson has paid £10 out to somebody called High Street, and that's therefore reduced the amount of money he's got in his bank, and therefore they update the balance to say that Patterson now has £25 in the bank, or from the bank's point of view, they now only owe him £25. When PR Patterson receives some money, so here he's received some money by a transfer from somebody called Regular Times. Okay, the bank would credit it by £46.50, because the bank now owe an extra £46.50 to Patterson, and therefore they would increase the balance. Now, from Patterson's point of view, well, he thinks of that as being a bigger asset of being owed money. He's owed an extra £46.50, and so in Patterson's accounts, that would appear as a debit in his bank T account in his ledgers. So if we look at Patterson's account, I've just reduced this down to imagine there's just 3 transactions during the month. Opening balance is a credit balance for the bank in their accounts, but for Patterson it's an asset. So he would say in his accounts he's got a balance brought down of 35. He then pays some money out by cheque on the high street. So I assume that's for pet food, because he's going to debit his pet food expenses account for £10. But in the bank, he sees that as being a credit. It reduces his asset of being owed money. He's then made another purchase from Pet Care PLC, and I've just assumed that that's proper purchases because it's some fish. I've just made it up. Okay, and that would be a credit entry in Patterson's T account called Bank. Although from the bank's point of view, that's reducing their liability of owing Patterson some money. So they've debited his account and then finally, somebody has transferred some money to him called Regular Times. So that's somebody perhaps who's bought a dog from him, or some birds. Okay. Patterson is going to debit his bank because now he's gained an asset of £46.50. He feels wealthier, and he would credit the account of Regular Times, who I've assumed is a customer. Now he would balance off his bank account like normal. Okay, he's balanced CDs on the credit side because this is a debit balance. On the 1st of June, he has £48.50 in his bank as an asset. As you can see, the final figure is the same as the final balance figure on the bank statement. Okay, but if we have a look at this from the bank's point of view, well, the bank are getting cash coming in or going out for all their transactions with Patterson. So from the bank's point of view, okay, they have got a liability to start with that is Patterson. They owe Patterson some money. Okay, Patterson then pays some money out, which the bank have to give effectively to Patterson's supplier. So that is going to debit Patterson's account in the bank, but they would also need to credit cash because there's less cash in the bank. Similarly with the transaction with Pet Care, because they give some of Patterson's money to Pet Care PLC when the cheque gets presented, that is going to reduce the amount of money that the bank owes to Patterson, and it's also going to reduce the amount of cash which they have in the bank. So therefore they're going to credit their cash asset. And then we've got the final transaction here where Regular Times transfers some money across to Patterson. And from the bank's point of view, they will now have £46.50 more cash in their possession than they had before. But what it will also do is it will increase the liability of owing money to Patterson. Okay, and then they work out the closing balance, £68.50. Okay, exactly the same balance on Patterson's account as on the bank statement. And in this case, also in their cash account. So I assumed this is a very strange bank, and this bank only has one customer who deposits and takes cash out, and therefore the cash balance is £68.50. Now, in reality, for a bank, they've got thousands of customers all putting cash in or taking cash out, and therefore Patterson's cash going in and out would just be a very small part of the overall cash book. So this is the reason why this is giving the same answer, is just because for simplicity, I've assumed that we've got one customer in this bank and it does nothing else with its cash. Okay, if we look at the cash account for the bank and the bank account for Patterson, this was the other reason why I assume that there was only one customer that ever put cash in or took cash out. The cash account of the bank actually looks exactly the same as the bank account that the business would have done, that Patterson would have done in his accounts. Okay, but the most important thing to note here is that the bank statement looks exactly the same as a PR Patterson account that the bank does. So the bank statement is a liability account, or a supplier account, if you like, for its customers. So the opening BD is a credit balance, and that's what I've already told you this 35 is. The £10 cash that was paid out from the bank account to a supplier via a cheque for Patterson, that goes on the debit side of the Patterson account. The cash transaction, sorry, the money paid out to Pet Care PLC goes on the debit side of the Patterson account because it's in reducing the amount of money that they owe. And then the money that comes in from Regular Times goes on the credit side of Patterson's account because now they owe an extra £46.50 to Patterson if he comes to the bank and wants to take it out. Hope that helps. Thank you very much. Bye-bye.